This week, stock investors have concerns as the indexes near correction levels. They will have one eye set on the Federal Reserve and the other set on earnings. The FOMC will meet on Wednesday, and the rate announcement will be made on Thursday. It is widely expected that the Fed funds rate will remain unchanged. Thus, the target federal funds rate will remain between 5.25% and 5.5%. Thus, the key message or conclusion drawn from the FOMC meeting will be if a rate hike at the December 13 meeting will be more or less likely. Current market predictions sit at 22%. Also, if or when rate cuts could start in 2024, what will be the catalyst? The major catalysts to consider are all related. They are falling inflation, a weakening economy, and rising unemployment. Last week, the major U.S. stock indexes fell, which was largely due to the mega-cap technology corporations. Google lead the way. The S&P 500, SPY, fell 2.53% last week, closing around 4,117. The story was that it was down for 4 out of the 5 sessions. Friday's closing price was more than 10% below the S&P's 52-week high of 4,588.96 points reached on July 31. Thus, the benchmark U.S. indexes are entering correction territory. 11 S&P sectors finished down on the week. In fact, the utility sector, XLU, a classic defensive sector, this was the only positive. The recent top performer, energy, XLE, was down over 6% on the week. Communication services, XLC, lost more than 5%. The top performer for 2023 technology, XLK, fell almost 2%. To highlight mid-last week, the NASDAQ composite touched the correction zone. Certainly, a key drag on the S&P 500 index and the NASDAQ 100 are the increasing bond yields. In particular, at the long end of the U.S. yield curve, this trend is set to continue. The 10-year yields increased to over 5%, currently 5.03%. The yields on the 10 years were sitting at 4.06% just 3 months ago and 3.76% only 6 months ago. There is a debate about whether current economic data does not warrant retaining short-term rates at current levels. Cuts in the Fed funds rate are starting to be predicted. This is one of the debates the FOMC will be having at its meeting this week. There are increasing concerns that the U.S. economy may respond negatively if the Fed over-tightens. Disinflation is a faintly emerging but very real risk. The 125 basis point increase in 10-year yields over the past 6 months is a warning sign. Keep in mind, rising yields at the long end is not over. The idea of persistent inflation, quantitative tightening and the likelihood of a normalization of the U.S. yield curve could push yields up a further 100 basis point from here, with yields peaking at around 6.00% or above in 2024. Not a positive for equities as the equity market risk premium will be at least 8.00%. More volatile stocks could demand 12% and above. The U.S. PCE deflator data, the Fed's favored inflation indicator, was in line with market forecasts. Thus, the potential impact of Fed policy predictions was little influenced. The September PCE deflator data was higher than expected, at plus 0.4% month-on-month. The year-on-year number of plus 3.4% was in line with market forecasts. The September core PCE deflator result of plus 3.7% year-on-year was in line with market predictions. The September personal income report was somewhat below estimates at plus 0.4%. But the September personal expenditure report was above the predicted plus 0.5%. All the graphs in this video are by BARCHART. If you are thinking of subscribing to BARCHART, my affiliate link is in the comments. Also included are my affiliate links to the online brokers, eToro, First Trade, and FX Primus. These videos give a quick overview of the U.S. stock markets with a couple of stock ideas. Issued on Mondays and Fridays based on the underlying blog. Visit my blog site www.smartestdata.blog. If you like these videos, hit like and subscribe, it really does help the channel. See you in the next video.